All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. After Apple's earnings, we talked about Apple and the earnings report and what was in it and what was going on. And one of the comments that I made was the reality is Apple is not cheap. And it's not cheap enough to have flaws that will be overlooked. And we were looking at a time where Apple was pretty much the most expensive that it has been historically. And now the stock has fallen, and it's fallen almost $100, about $90 from its highs. And the question comes down to, well, is this fundamentally cheap? Has Apple gone from this fundamentally expensive position to now with the just saturation of bad news? Now is it cheap? Is it something that you can go out and start to pick up and say, man, I picked up Apple under 150 and got it for a song from an investment standpoint. From a trade standpoint, there's a few short-term arguments to be made. Looking at the option values, I don't think either one are worth really delving into. But the fundamentals of Apple are fairly simple and they're fairly straightforward. And I know everybody's focused on iPhones and, iPhone growth and all of that. And, can they transition into a services company with iTunes? And, I mean, the amount of money they're printing on iTunes is just incredible. It's just absolutely incredible. But Apple has gone through plenty of dips before. Right? This is not like, oh man, this is the first dip Apple's ever gone through. I mean, it's gone through many dips in its history, from post Steve Jobs to the dip it had here in 2015, 2016, the dip it had in the financial crisis. Right? It's gone through plenty of dips, and this isn't anything brand new. This isn't anything that we look and go, wow, this is historic, or anything of that nature. But if we take a look at some of the past dips, there's some clear trends, right? And if we look at what Apple did today, what did basically they do? What does a company do when they come out and they kind of give an earnings warning? Well, they lose investor confidence. So the first reaction is you gotta sell, you gotta get rid of. Now, I don't know how many are actually left to sell Apple that haven't already during this landslide. I don't think this is a company that hedge fund managers are deep involved in, and to where they have to make these massive decisions to sell right away. It is one where the magnitude of drop leaves it a little underinvested relative to historic norms. But if we think about Apple fundamentally, is this a stock people buy for dividends? No. No, not at all. Never has been. Probably won't be anytime soon. Is it a company that people buy for earnings stability? Do they buy it for revenue growth? Do they buy it for margins? What do they buy Apple for? Well, if we look fundamentally at their chart, and we just take a look over the last 10 years, and we look at revenue when it comes to Apple has been bought historically for revenue growth, right? That has been the main driver, the revenue growth. And when revenue growth has been strong, so has Apple's stock price. It took a ding, with the passing of Steve Jobs. Even though the revenue growth, yes, it slowed a little, but it didn't stop. But with the passing of Steve Jobs, the investor confidence, went away for a bit. And then it was, okay, all hands on deck. And the stock rallied. And you'll notice the stock topped before revenue growth topped, or before this revenue top, right? You started seeing in Apple's reports and in their guidance that, hey, things were going to slow down a little bit. And Apple went through a pullback. And during this time, we talked about it fundamentally. And we talked about the change of revenue guidance going forward and how cheap Apple was historically with the revenue guidance change. And we have seen Apple just, go go gonzo here. It has had a great run. Well, it's now in one of its pullback phases. It was catalyzed, with some of the market correction, then further catalyzed with their last earnings report, and then even, further with, with their stuff today. But they finally have had a substantial pullback of this massive upward move that it had had. It's not its biggest pullback in history, right? It's gone from 225 down to 145. It was 100 and went down to 60 here. I mean, these percentage moves were pretty substantial. Obviously, Apple's had some stock splits, so these aren't the actual numbers that they traded at that time. But on a percentage basis, this isn't unheard of here for Apple. But the question comes is, can we start to compare Apple today to what Apple was here at the beginning of 2016 or at the middle of 2013? Can we kind of compare Apple, now to what it was back here and say, look, at least it's fundamentally cheap. So yes, investors may not be eager to pile back in and to throw it up another $100. That's not going to happen, right? If you're going and buying out of the money 200 call options on Apple, it's not going to happen in any time real soon, right? It's not going to make that type of monster rebound, barring just some pretty, historic things happening, right? But it is one where we can start to say, you know what, maybe it has some basing out. And you'll notice that Apple, on its major corrections, it's never had just sell off and then boom, rally up real hard, real fast. It's had multi-month basing out periods. And its biggest moves have come after these multi-month basing out periods. Are we in a multi-month basing out period right now? No, we're not. We're absolutely not. So, from a trade and short-term standpoint, I think the best the bulls can expect is, a snapback rally, right? And that likely gets sold into, and these lows get retested. That would be the likely here. But is it at a position where you can start picking up shares and think, hey, you know what? This is a really good bargain. Well, let's take a look at a PE ratio. Right, let's just take a look at just the traditional way to value a company. And here's Apple with a PE ratio of 12. Now, 12, some people say, well, that's cheap. Some people say that's expensive, right? It's the price of the stock divided by the earnings per share. The reality is for some companies it's cheap, for some companies it's expensive. But for Apple, we can see historically the PE ratios it's traded at. And when it's had its corrections, the PE ratio has gone where? It's broken below 10. All right, so it's broken below 10. That's where it's kind of bottomed out at. We're not at that area yet. We're not down to that area here just yet. We're still kind of in that, we talked about US Steel a couple weeks ago. Thought, when U.S. Steel's trading at 20, is it cheap? Yeah, it's a lot cheaper, but it's still not at its kind of bottoming out area. And now U.S. Steel down around 18, it's getting a lot closer to that bottoming out area. But so far, it's not here from just a PE ratio standpoint. Okay, well, PE ratio is one number, right? I mean, this is a market full of a lot of numbers, so let's go take a look at price to sales. Right? And we can take a look at the price of the stock relative to its sales on its corrections. It's come back to about 2.4. That's where it's come on some of its recent corrections over the last 10 years. Are we there? No, we're not there. We're not there. Just absolutely not there yet. Getting close, but we're definitely not there. What about price to book value? Right. Just the price of the stock relative to its book value. It's at 6.4. That's nowhere close to some of the levels that it was before. Right. So, can we make an argument that Apple's cheap? Yeah, we can. Relative to what it was a few months ago, but historically, over the last 10 years? No, we can't make that argument. It doesn't hold a lot of water with a lot of the metrics that are out there. And so when you have a company that's signaling that its revenue is about to slow down, right? It's not in this phase where it's signaling that revenue is going to increase. You have a stock whose path of least resistance is ultimately going to be lower. And will it hit a cheap level? Yes, it will. And when it hits into that cheap level and Apple starts talking about future revenue growth, well, now we're talking about a stock that investors are going to jump back into. The shorts are going to leave, the investors are going to push on into. And so it's one where, yeah, you know what, are you probably okay if you have a 10-year time horizon or 5-year time horizon to buy Apple right here and to say, you know what, ultimately I'll make money? Yeah, you're probably okay. But you may have to ride it down to 120. You may have to ride it a little further depending on, you know, how the market goes. Now, you'll notice I just showed the past 10 years. If we go max, and actually let's go to let's change this to 1996. Or excuse me, 2006 here. There we go. There we are. And we just come back a little bit further in time. You'll notice that when we had the financial crisis and Apple stock was dropping, you'll notice the revenue was still growing. It's one of the few stocks out there where the revenue grew during the financial crisis. That was one of the most amazing things about Apple. But if we look at the evaluation, the PE ratio of Apple back here, you'll notice that the PE ratio also came down to where these lows were in 2013 and 2016. Right, during the financial crisis. So if you say, well, you know, market's going to collapse and it's going to go down a heck of a lot more, you know, wouldn't that take and make Apple even cheaper? Well, not necessarily, right? During this time, from a price to sales, if we look at that, you know, big bad bear market, you know, on a price to sales standpoint, yeah, I mean, it was cheaper, but it came down here to about 1.6, so definitely a lot cheaper during that time period, and a price to book value here in 2009, you know, down here all the way in the 3 area. So, you know, it has definitely some room to fall to really be talking about historical chip contexts here. You know, is everything bad for Apple? No. I mean, if you go look at everything that was said and everything that was talked about, they printed basically $1.2 billion during the holiday week on iTunes. Just an absolute cash cow, right? During that week, and as iTunes, as it makes this transition from a let's sell as many phones as we can to you know, let's monetize iTunes and some of the other things that are under development, you know, we'll start to hear about revenue growth change and that type of thing. But the days of Apple revenue growth based on phones and how many iPhones of the new model are being sold, you know, those days are likely past it. You know, those days are likely gone unless there's some new major technological change. You know, people are not buying, you know, new phones, new tablets as often because they're just, you know, the marginal difference between them isn't as great as it used to be. You know, sure, there's still plenty of those that, you know, they want the new one, they want the latest, greatest every single time, but not to that same degree. So, you know, as we look at Apple, I don't think it's a story that is dead. I don't think it's a story that is, you know, worth taking and saying, you know what, I'm never going to look at Apple again. But I also don't see it in a historically cheap area to where we can look at Apple and say, you know what, they finally kitchen sinked it. They finally bottomed out. And, man, now this stock is just going to go up nicely from here. It's not in that situation. It would need another 20 to 25 points lower to get close to that situation. And I do believe that when it comes to Apple, any substantial rallies from this point are likely going to get sold into. until we start to see Apple talking about a revenue growth change. And let's face it, their comparables are very high, and they're not going to change this year. To keep up with what they were last year, it's going to be a tough feat. They were great. They were absolutely great. And you say, well, that's not fair to hold it against them. No, it's not, but it's how the market operates. They compare year over year. Well, how'd you do relative to last year? Well, last year we were phenomenal. You can't expect us to be that every year. Well, yeah, we do. We expect you to be that this year and even better. Well, it doesn't work like that. All right, Starbucks went through 2 years where it was just it was a victim of its own success, and its comparables just couldn't keep up because of how good they were. Now that the comparables have come down, everything looks relatively better, right? Chipotle Mexican Grill is kind of in that situation. Went through a really dark time, really bad period. Now its comparables, when you compare it now to what it was last year, it looks great. It's still not what it was 3 years ago, but when you start putting on those comparables, it looks great. We saw this with Las Vegas Sands yesterday, right? Its revenue growth or its Macau gaming growth is great when you compare it to last year. And this is a company that, last year some of its numbers were pretty, they started to pick on up, but it went through this really bad period in 2014, 2015. Then, okay, now we're comparing the numbers in 2016 to the numbers in 2015. They look a little bit better, but they're not great, right? It's hard to keep up. Well, then here in 2017, the numbers start to look a little bit better. They're not the best numbers ever, but how they look on a relative basis starts to improve. And, that's one of the tough things as we go into 2019. And one of the things that has to be looked out for as we get here into 2019 is 2018 for many companies was a really good earnings month or earnings year. And so to compare to that time period is going to be pretty tough. And so if you have companies coming out and just kind of tanking their numbers, so to speak, and basically saying, no, our numbers are bad. We're a victim of the trade war and all of that. Similar to something we saw out of FedEx. If you look going forward, next January, next December, is it going to be as hard to compete with those numbers as this year's numbers as it was this year to compete with last year's numbers? It's going to be a lot easier. And so the market, yes, it may go through a very rough earnings period. And I think that has to be accounted for. But what a really rough earnings period would do is make the comparables next year a heck of a lot easier. Now, if we go into a recession, none of that will matter, right? But who was it? One of the infamous investors who called for Dow 20,000. Basically came out this week, or came out, yesterday or the day before, talking, and basically said this. He said, if the economy doesn't go into a recession, the stock market is poised for a massive run. And he's spot on. He's absolutely spot on. If the market is priced in recession, it is priced in recession. If the market doesn't go in, or if the economy doesn't go into a recession, there's some serious upside to be had. But you need to see that, that catalyst switch. And so far, we haven't seen it. Yes, we see rallies, and yes, we see volatility and all of that, but so far we just have not seen a real change in the meta, change in the story, from bearish to bullish. And there's nothing in today's meta, nothing in today's story that gives the bulls any more advantage. Yes, I know. Yes, we got a report that the Democrats wanted to may impeach U.S. President Trump, and we saw the market rally on that. But that's not a fundamental change. That's not a fundamental driver. And we've seen a switch in the fundamental drivers today. And though that switch has turned those fundamental drivers significantly more bearish, not bullish. Thanks for hopping on. Have yourselves a great one, and we'll talk to you later. Take care.